If you've been paying attention to the stock market, you've probably heard of the Magnificent Seven, a group of 7 tech giants dominating headlines and market performance. Companies like Apple, Amazon, and Nvidia might seem like a sure bet. So you might be asking, why not just own these 7 stocks and skip the rest? The answer comes down to 2 key things: risk and diversification. Think about how much of your portfolio depends on just these 7 companies. If you only own these stocks, you're banking on them to continue to outperform for years into the future. But history shows us that no company stays on top forever. For example, in the late 90s, tech companies like Intel and Cisco were crowned as market leaders. Fast forward 2 decades, and while they're still around, they're nowhere near the wealth generators they once were. The same could happen to today's leaders. Owning these 7 stocks means your portfolio isn't diversified as well. It's extremely concentrated into one sector: tech. These companies operate in similar industries and markets, making them highly exposed to the same risks. If tech faces a downturn or regulatory pressures, your portfolio would likely take a significant hit. Instead, by diversifying across sectors, asset classes, and even geographies, you reduce your dependence on any one group of companies. For example, the broader S&P 500 gives you exposure to the tech giants while also balancing other industries like healthcare, utilities, and consumer goods. This approach helps smooth out long-term performance and reduce risk. At the end of the day, the goal is a portfolio that's built to withstand changes over decades, not just the next couple of market cycles. It's okay to own the Magnificent Seven, but make them part of a more balanced, diversified investment strategy. That way, you're not relying on their success to secure your financial future.